Welcome back, ladies and gentlemen, to the Capital Control Show. I'm your host, Derek Gruning, and this week we're discussing part 2 of a risky retirement. Last episode, we covered 4 or 5 major risks that potential retirees will be facing in the future. And in this episode, we're going to be talking about how the infinite banking concept can help mitigate some of those risks for these retirees and provide a better retirement picture for you in the future if you choose to implement the infinite banking concept. So let's go ahead, let's get into it. Last episode, we talked briefly about where your retirement income is coming from. In this episode, we're going to be focusing in on cash value life insurance as an asset to collect future cash flow from future income in your retirement years. Now, the beauty of it is this is an and asset. You're able to utilize whole life insurance when it's properly structured and designed, and you can still utilize these other assets with the same dollars. Your dollars are doing 2, if not 3 jobs at the same time. That's what makes this strategy so powerful. For example, you could be paying premium and storing up cash value in your policy and utilize a loan to go and purchase real estate and get the benefits of being a real estate investor. You can have both and rather than either or. And we'll talk about that more in just a few minutes. Now, some of the biggest fears in retirement that we discussed had to deal with personal finance. In fact, the top 5 biggest fears for retirees is related to their financial picture. And this has a direct correlation and an effect on your physical and mental health. And so if we can alleviate these risks or mitigate them and provide ourselves with a better financial picture, ideally that means that we're going to be living longer and able to enjoy our retirement for a greater length of time. And some of these risks that would legitimize these fears, we're going to talk about those again here briefly, but then we're going to focus in on how infinite banking can alleviate some of those risks. Let's talk about Nelson Nash. He's the creator of the infinite banking concept. It's not something that I came up with. This is something that Nelson came up with well into the 80s, and it kind of came at a crisis event in his life. And now he's been able to share his story and document how he's utilized his policies and built a system of policies for his family members. And I believe you'll see that this provides us with a great source of passive income in our retirement years. Let's talk about that first risk. The big one is taxes. If the majority of your passive income is going to be taxable, or even a large portion of it via maybe your 401k, if it's a traditional 401k and your employer has been putting in pre-tax dollars, there's a portion of your 401k that will be taxable. And so you may be experiencing a higher income tax bracket in the future, which would reduce your net spendable income. Neither you nor I really know what's going to happen with tax brackets in the future. So the best thing we can do is help mitigate those risks and mitigate the amount of taxes we're paying to the federal government. Now, I'm a fan of Ron Swanson, and he says, cursing, there is only one bad word, and that's taxes. So I want to eliminate taxes as much as the next guy, and the best thing I can do is come up with a tax-free income for the rest of my life. And this is where infinite banking really gets to be a powerful idea for people in retirement. We can access the cash value as the source of retirement income, all the while still having a large death benefit, ideally that we can pass on to our loved one and heirs. We can take withdrawals up to the basis, meaning the cumulative premium that we've paid over the number of years. And that's the first way that we want to access that cash accumulation that's been building up in the policy. The second is what's called a policy loan. And this is designed into each contract to where you as the policy owner have the right to access the cash value before any other entity. You can access the cash from the insurance company as a loan, and loans do not qualify as taxable income. There is, however, an interest charge that accumulates with those loans. And this is why it's so important to work with a professional who has been around the insurance business and knows how to utilize infinite banking to help you get a picture as to how much income and for how long of a period of time you can collect that income for. This should be reviewed at least on an annual basis. Meeting with your infinite banking practitioner and discussing how much income you think they could take that year. And this is going to fluctuate. It's going to be based upon how the performance of the insurance company has done over the number of years of that policy and into the future. And it's also going to be contingent upon interest rates. We can discuss that more. If this is something that you're interested in, I'd love to sit down with you and discuss what the possibilities are for you utilizing the infinite banking system as a source of tax-free income for the rest of your life. What about market volatility? Last episode, we discussed sequence of returns risk, and we illustrated it here by this graphic. Depending upon when somebody is retiring, they could be drawing down their investment value quickly if they are drawing it down when the stock market is experiencing a decline. And even though both of these cases here, both the blue and the green, have an average return over those 15 years of 4%, depending on when they're taking that income, if it's negative, as in the case of the green investor, early on in their retirement picture, it's going to draw down that investment value rather quickly. Whereas if it sustains a positive growth over a number of years, like the blue investor, he's not drawing against that investment value as quickly, and therefore he's able to sustain the amount of income that he's been withdrawing from that asset. But infinite banking isn't tied to the stock market generally if you're utilizing a mutually owned life insurance company, which is what I would urge you and recommend. And that's one of the beauties of it. Nelson Nash says in his book, Becoming Your Own Banker, on page 22 of the 5th edition, he says, the policy is engineered to become more efficient every year, no matter what happens. Then he goes on to say, not too many people are familiar with the concept of getting better no matter what. And here's a graphic that you will see in your illustration as part of your life insurance application. First, notice the cumulative premium in green. Yes, as you continue to pay premium, it builds up. That obviously is the cumulative portion. But in the instance of the example we're going to be looking at here in the next couple of minutes, that premium amount is no longer to be paid after the age of 65. And that's the way that I've designed this policy. But notice the cash value in blue. Every year, that cash value increases. It is guaranteed to increase every year. There are no down years because we're not tied to the stock market. So this gives us a picture of being able to collect income without the risks of the stock market going down and potentially drawing down your investment value too quickly. Also notice the death benefit. There's a portion here where the term rider or term insurance component of the policy falls off, but generally speaking, you're noticing that the death benefit is also increasing year over year. And this is what most people don't wrap their head around. You need guarantees in life. You need something that is efficient, that is going to get better every year, without exception, without fail. Doesn't matter what the market's doing, doesn't matter what politicians are doing. And this is one of those great assets that can be utilized for that purpose. How about inflation? We looked at this graphic from Truflation last episode. That noticed that the aggregate inflation from January of 2020 to July of 2024 was over 25% as an aggregate. Can an infinite banking concept and an infinite banking policy help alleviate inflation? While the performance of the infinite banking concept policy can combat inflation, it will not likely outperform inflation by itself. And that's thanks to your politicians and the fact that they keep printing money every year without exception. But we can combine IBC, the infinite banking concept, with an inflation hedge and get the best of both worlds. We're combining the two. We're going to see better results than if we only utilize one option. As I said earlier, this is an and asset. You can do both and, not either or. We can do both IBC and real estate investing, or both infinite banking and stock market, rather than say, hey, I can only do the stock market or I can only do infinite banking. You can do both and with the exact same policy. And that's the beauty of this concept. So how can we combat inflation? Well, with an inflation hedge, and most people will either say that the stock market is a potential inflation hedge, gold could be an inflation hedge, commodities, Bitcoin, cryptocurrencies, real estate is a great inflation hedge. As values increase over time, you need that asset that is going to keep up with inflation as much as possible in your general area. Your infinite banking concept policy can help in that area, but it's not likely to do it to the degree that inflation is running rampant and wild right now. And so we want to utilize first our infinite banking policy, then we want to access it with the cash value via a policy loan, and then purchase an investment or asset that is going to be a great hedge against inflation over the long term. How about the loss of Social Security? This is a risk for many people. And better yet, can we outperform Social Security, or could we fix Social Security? Well, first, Social Security provides a source of income when you retire or if you cannot work due to a disability. But could we utilize the infinite banking concept as a better source of income? I believe so. And it needs to have these 4 attributes. It needs to be, 1, it needs to be guaranteed. Just like Social Security, it's pretty guaranteed for those retirees to collect that check in the mail each week or every other week or once a month. Secondly, we need to have more income. Obviously, that was the goal. How can we have more income in retirement? And ideally, for it to be tax-free. The third benefit, if we have access to the cash value over the entire length of the policy, so long as we're alive as the owner, that's a great tool that we could utilize for other opportunities should they present themselves. And then lastly, a large outsized death benefit greater than the cash value and greater than the premiums paid over the life of the policy. Now that can be transferred to your heirs income tax-free and can be potentially estate tax-free. Now, of course, I'm saying this based upon current tax code in 2024, and this would be subject to change. You would want to meet with both your infinite banking concept practitioner and with your tax professional. But first, let's look at some examples here of how we can utilize a policy for this better source of income in retirement. Could it be better than Social Security? Could it outperform what people are getting in their Social Security checks? Let's look at a case study here of a 25-year-old male. His current income is just over $127,000 per year, which is the maximum income to that currently that Social Security can tax. Anything above $127,000 per year is not taxable to Social Security. The Social Security tax for this individual would be $15,772, or 50% of it is coming out of his own paycheck, 50% of it is from his employer. And let's say that this individual starts collecting his Social Security benefits between the ages of 65 and 67. How much income can this guy receive as his Social Security benefit? Well, if things stay the same as they are today, which is unlikely, but it would be anywhere from $36,000 to $42,000 per year. And 0% of those benefits are taxable at this current moment in time. If he had any other sources of income above that roughly $40,000 per year, then he could potentially be subject to income tax on that income. And therefore, he would have less net spendable income in retirement. Now, there are a couple of links there for you to peruse to determine this for yourself. How much potential Social Security benefits could you be looking at in the future? And how much income could that generate for you? Well, we're going to try and do something apples to apples here. We're going to design a policy with the same premium amount as the total taxes that this gentleman and his employer were paying to the federal government for Social Security. As you recall, that tax amount was $15,772. And the premiums of this policy mimic that. And as you can see, in the first year of paying his premium, that cash value is $13,000. And it purchased a death benefit of $507,000. Now, he's not going to start collecting income from this policy until age 67 when he qualified or when he chose to collect Social Security. But notice that after age 55, the premium amount is reduced slightly. And that's because the term insurance rider that was added to his whole life insurance policy falls off. It expired after those 30 years. Now, starting at age 67, that cash value has accumulated to $1.7 million, and now he has a death benefit of $2.4 million, and he's going to start receiving income from his policies. First, he's going to take out withdrawals, and then after he's withdrawed up to his basis or up to the total premium, he is then going to take out policy loans against the cash value. Now, this could sustain itself until age 121. Notice that the cash value and the death benefit continue to increase as time goes on, even though he's taking out that $40,000 income tax-free. But with Social Security, they calculate a life expectancy and a cost of living increase. Currently, the life expectancy of a 25-year-old male is 75 years of age. Now we're also going to assume a 3% annual cost of living increase to keep up with quote-unquote targeted inflation. Here, the same premium has been paid. It's the exact same policy. Now the only difference is we're calculating an increasing income every year of 3% annually. And so, just to illustrate this, in the right-hand column of his income received, first he starts off with $40,000 a year, and by age 85, now he's collecting $70,000 per year from his life insurance policy. But once again, notice that the cash value continues to increase each and every year, and so does his death benefit. By age 80, now that death benefit is starting to decrease. He's beginning to collect more income than can be sustained in the policy. But his policy is still active, and in fact, he can continue to do so. But what he's going to see is that both his cash value and his death benefit are now going to be going down. They're drawing against it faster than what was being built up in the policy. But now, we've been doing this till age 85, which is 10 years longer than the average life expectancy as is calculated today for a 25-year-old male. So I hope you can see that, one, we're able to still match that cost of living increase, and the policy is still active for at least another 10 years and well beyond this, I believe, potentially into his 90s or even to age 100. If he were to die at any point, he's got that outsized great death benefit that he's passing along to his family and loved ones, income tax-free. But could we double it? Yes, we can. We could receive up to $80,000 per year tax-free until age 104. In other words, he's able to utilize this policy if he could opt out of Social Security, and instead him and his employer would pay premium to a life insurance company as designed in this policy here. He could receive almost double the amount of benefits per year than what he is currently receiving today from Social Security, or what he would be forecasted today from his Social Security. He would be able to receive $80,000 per year income tax-free until age 104 versus just $40,000 per year for the rest of his life. Now, at age 104, what happens? At this point, the policy can't sustain that income for any longer. We've maximized the income, and now the death benefit has gone down to zero, or is going to zero. But I don't know about you, there's very few people that are actually living to age 104 today. And this just goes to show you the power behind an infinite banking concept policy and how this can be utilized as a potential source of retirement income. And I believe could help solve the Social Security crisis in America if we would just change one thing. Just change where the money is going to. Instead of it going to the federal government, partner with a mutual life insurance company. And we would have more income for retirees. They would have access to cash value and a great income tax-free death benefit to their family and loved ones. Who wouldn't want that? And I think that provides us a much better picture than what current Social Security benefits do. But can we do this? Can we do this can we actually opt out of Social Security? Well, for most people, no, you can't. But you can still do this, even though you may not be opting out of Social Security. All you're doing is just changing where your dollars go first. Instead of it going into your 401k first, put it in your life insurance policy. And then if you want to still be exposed to the stock market, you could. Or maybe you want to have access to capital to deploy in other assets like gold or cryptocurrency or horses or paintings or real estate or a small business. The options are limitless and they're totally up to you and your imagination. But here, what I'm hoping you've seen is that we're able to mitigate many of these risks in retirement simply just by changing where our dollars go, by utilizing a properly structured and designed whole life insurance policy from a mutually owned life insurance company. If this is something that you're interested in and would like to learn more and discuss the options and capabilities for you and your family, please reach out. You can send me an email at derek@capitalcontrol.org, and I'd be happy to work with you. And I look forward to seeing you in the next episode. Thanks.